So let's talk about the when we talk about the Fed raising rates, we're talking about the Fed funds rate. So I want to talk about how that is impacting mortgage interest rates, because most of the people that watch our show are either consumers buying or selling homes or real estate professionals, right?
Yeah.
And so I want to talk about specifically, mortgage rates went into the 7% range. We haven't seen rates like that in a long time. So I want your take on how things are, these decisions that the Fed are making are impacting rates. And then I want to unpack mortgage interest rates based on your experience, what happens to rates in a recession.
Got it. Okay. So I'm going to give you I feel like I'm beating a dead horse, but now I'm good at it because I've explained it a million times. So mortgage rates go up when the Fed raises their rates, and the Fed, to be clear, does not set mortgage. There's no set mortgage rates. Like, mortgage rates are determined by a bond market, right? So why do they? Yeah, but they're like, okay, well, Steve, Fed's raising rates and mortgage rates are going up. It seems like pretty obvious. So here's how it goes. Both mortgage rates and the Fed funds rate are both 100% driven by inflation. So what the Fed funds rate does is the Fed has, it's money that banks have. So a bank is required to have a certain amount of assets on hand to cover the money that they're lending. So if a bank has more assets than they need to cover their balances, they can take that money and they can lend it overnight. They lend it to giant companies, maybe overnight, maybe it's a week, 2 weeks. They lend it to giant companies to make payroll, or they might use it for research and development, or like different product offerings and innovation and things like that. So what happens is, when inflation is high, when the prices of things are going up, the Fed raises that cost for companies to borrow money short term. And what that does is it essentially slows down hiring, slows down product innovation, it slows down sales.
That's exactly
As
right.
These companies are slowing down their sales, their stock prices tend to come down. People can invest their money in these things, and they charge less for their product if there's not as much demand for them. On the mortgage side of it, so the Fed's raising rates to do that, right? So they're fighting inflation with this tool that they have.
And just for the audience standpoint, I think this is really important, is that they understand that the Fed is the United States central bank.
Yes.
So, and the Fed funds rate is the rate in which other banks borrow money from the Fed to your point, lend it out to maybe other institutions. Or direct to the consumer, and then they charge a premium. Sorry, go ahead.
That's all right. So mortgages, on the other hand, the reason mortgage rates are going up when inflation is high is because mortgages are traded in a secondary market, so mortgage-backed security.
That's right.
And that's like a bond.
And we're going to talk about that too, for sure.
So the way it works is like big, like sovereign funds, pension funds, foreign countries, which I can get into in a minute too, which is interesting with what currency is doing. But they'll take these mortgage-backed securities, and these big funds will invest in these as part of an overall investment portfolio for billions of dollars, right?
Sure.
And a part of their money will be parked in a mortgage-backed security that provides a low rate, very safe place for your money. So instead of your pension fund having cash earning nothing, they'll put it in a mortgage-backed security or a 10-year treasury earning a very small amount. Well, what happens is, during a time of high inflation, and as inflation's rising and prices of stock is going up and things like that, people would rather invest in the stock market where they're going to see, or invest in assets where they're going to see appreciation as inflation grows and the prices for things go up. They'll invest there rather than a mortgage-backed security, because if you invest, your $1 million in mortgage-backed securities in January, and those investments are going up or providing a rate of return at 3% or 3.25%, and inflation's going up 9%, well, at the end of the year, you've lost 6% of your money, right? So what the mortgage-backed security market does is say, okay, we still need this liquidity. Like, we need to have a function as a mortgage. That's how in order to write more mortgages, they sell these mortgage-backed securities. They take that cash and they write more mortgages and they back more of them. So what they do is they increase the yields on these things, right? So maybe you're paying back 5, 6, 7% in order to get people to invest their money in them. So what happens is mortgage rates go up because they have to basically, they're the fuel, right? They're the fertilizer to grow these bigger returns.
Yeah.
So what'll happen though, eventually the yields on mortgage-backed securities will get high enough where it becomes a good investment, where people are like, oh, this is a good place. I can make 7%. We're on the brink of a big recession, which we know what that does to a stock market. We're already seeing the stock market this year, right? So as these become a better investment in a recession, which this is leading into what we'll get into later, But there's a larger demand for mortgage-backed securities. So what do you do when there's a larger demand? You can pull back the yields that you pay on these things. You don't have to pay out as much when more people want them, and we start to see mortgage interest rates come down in a recession.
So that it was a great transition, and I really want you. Well, you just did, but
sorry,
no, it's great. It's great.
I got going.
It's
I lost
exactly what I wanted to talk about. So I wanted the viewer to understand that even though mortgage interest rates are going up like crazy, which has slowed down the demand in the housing market, that the further we get into a recession, it actually, the opposite tends to happen, that mortgage interest rates start to go down based on everything you just talked about. Now, the question is, for the viewer, they say, okay, wow, that maybe gives us something to potentially look forward to if you're in the real estate space, or you're looking to purchase a home, or you're looking to sell and buy a home. What needs to happen for that to occur?
Yep.
And then when do you see something like that happening?
So going back to, and I get a lot of my economic data and guidance from the MBS Highway, which is Barry Habib.
Absolutely,
and
great guy.
He does every year. He does the thing where he shows like, here's what I forecasted and here's what happened, and then he's like, here's my forecast. So he does like a whole here's what I'm going to tell you. Here's how right I am all the time. Then here's what's going to happen. So they're seeing that, again, as I said, we're going to start replacing higher inflation numbers for year-over-year figures next month, which is in November. So we'll start to see a meaningful reduction or a meaningful change in inflation to the better going forward from there. So I think that in my opinion, and again, going back to mortgage-backed securities being pretty appealing with their yields right now, and with the rest of the globe seeing what's starting to happen, I think that in the next 6 months, we'll probably start to see interest rates come back down. Who knows exactly? I mean, Fannie Mae's been out and said in 2023, we could see 30-year rates at 4.5%, which is a 2% decrease now. And
which makes sense.
Just that's $300 a month on a $200,000 loan. It's a big difference. So
massive. But
you never know. That's what's weird about these things, because we have other factors, right? There's a war in Russia right now.
Yep.
And energy costs. I mean, I was thinking about this the other day when I was in like 2008 or 9, I bought a GMC Envoy, and I bought a used car. I'm like, man, this thing's empty. Like they don't fill up used cars.
Yeah.
So I went to the gas station. I filled it up. I'm like, oh my God, my gas was $69 to fill up my gas tank. I was freaking out. I'm like, I'm not driving this. I gotta get a Honda. I'm going right back. And you think about it now, gas is higher than that now.
Right.
And we're just paying it. You know what I mean? So it's going to be kind of an interesting thing, but it does smell a lot like the last recession. Like, here comes energy prices going up, and like all of these things are,
Well, the important thing, and we're going to start to transition now away from the Fed and their meeting, and we're going to start to get into more of the housing market. It's just simply a supply and demand, right? Yeah. We talk about it on every show. Yep. It is so simple, yet it's so hard for people to understand, because the media loves to put out very, very worrisome clickbait titles that 100%. Freak out the consumer.
Yeah.
And the thing is, mortgage rates, as they skyrocketed as a result of inflation, it has slowed down the market. Home sales are down 20%. We're going to talk about that. You're seeing mortgage applications go down like crazy. And so the interesting thing will be, what will happen if interest rates go back down, because inventory levels are still really low. We still have a very strong housing market. We're going to get into all the details in a second. Yeah. If we start to see interest rates go back down, do we just pick up right back from where we left off? Even if they settle in at 4.5%, it's a great market.
It's crazy.
Thoughts?
Still very super low. Yeah, I mean, and so I don't have I work in the mortgage space, right? Like I'm actively pre-approving people and closing loans and writing loans. So I look at a lot of just like the main, I call it Main Street. Like I'm down in there with the people, and there's a lot of buyer. I mean, the home buyer today is so savvy within like the last 3 years, because the media is so in your face with data. And I tell them all, I'm like, you understand that the headline that you're reading is literally to get you to buy the UGG boots in the ad alongside the meat of the article.
That is exactly right.
But that's one other thing. But I mean, I have a lot of my pre-approved buyers that are like doing two things, right? So I have pre-approved buyers that are like, I'm going to buy now and I'll refinance. So a lot of them are, I've never done a 2-1 buy down thing, which is like a whole mortgage program deal, but I've never done one of those before. I've done like 3 or 4 of them recently.
Interesting. Wow.
And I've got a lot of people are saying, I'm just waiting for rates to come back down and then I'm going to buy something. Like I'm saving more money and I'm going to be ready when the market, when rates come down into a range where I want to be. And I'm trying to tell them like, this might be, if you're counting on stopping renting, like if you're going to leave the renting world and get into a home buying world and you're going to wait for rates to go down, I'm like this, because it's either the purchase price or the rate, right? What do you call it? Chicken or the egg or something?
Chicken or the egg.
Like if your plan is to not move now, you're going to move in a year because rates will be lower. I told him, I said, the only thing that we know right now is what a house costs right now and what the rate is today.
Yeah.
So we don't know what housing prices are going to be in a year and we don't know what rates are going to be in a year. But I can tell you, if rates are really high in the next year and housing prices stay high, guess what else is going up? The rent.
Yeah. Oh, absolutely.
The rent's going to continue to go up.
Absolutely.
So
well, and so I guess let's talk about that. So still they're based on, people trying to hypothesize, hey, what is going to happen with the housing market? Is it going to crash? What is going to happen to mortgage rates? Well, here's the thing. Powell, who runs the Fed, came out in the meeting, okay, and a reporter literally asked him, are you going to crash the housing market?
Yeah.
Right? By selling off mortgage-backed securities. So take a listen to this, and then we'll talk about this.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now and not something I expect to be considering in the near term. It's just, it's something I think we will turn to, but the time for turning to it has not come and is not close.
So what's so interesting about that, it's like, I don't know what else the media needs to hear, that the housing market simply is not crashing. What it is doing, and he said this earlier in the meeting too, and we'll play that maybe in a different show, is he believes that it needs to go through a correction. It needs to normalize, and that is what I've been talking about for months and months and months since we've been going through this high inflation, is that the housing market is simply normalizing, Steve, to a pre-pandemic level. And it's what it needs to do.
Right.
Jerome Powell also talked about, he also believes that home prices will remain high for quite some time. That's what he said. And so, it's just interesting to your point earlier about how the media is just selling the click for the advertising, but the consumer freaks out and says, well, should I not do anything? What should I do? Now let's get into the housing market. All right. So
one quick thing too on that, just so people know what he's referring to with balance sheet runoff and selling mortgage-backed securities. So when I talked about fiscal accommodation, so where I said there's the mortgage-backed securities that the pension funds and all these things buy and they invest in mortgage-backed securities. Well, during the pandemic, and one of the things that the Federal Reserve will do to bring interest rates down, which puts more money in a consumer pocket, is the Fed will go out and buy like billions of dollars in mortgage-backed securities every month, and it provides liquidity for that market. So as I said, you don't have to provide much of a rate of return at all when you have a guaranteed buyer, regardless of the price. And so what's happening is the Fed has trillions of dollars of mortgage-backed securities that they own. And what they're doing right now as part of their fiscal tightening is what happens, those every year or whatever term it is, those roll over. So like, okay, this mortgage-backed security rolled over, you made your 3% or 2.5% or whatever on this bond. And normally what the Fed was doing was saying, okay, we'll take that 2.5% and the principal and we'll just reinvest it back into the mortgage-backed security market. And so what they're doing as part of this fiscal tightening right now is you just mentioned it, like the balance sheet runoff. So what they're doing is they're letting them run off. So when these mortgage-backed securities are maturing, they're just letting them fall off. They're not reinvesting the gains and they're not reinvesting the principal. They're just letting it roll off, which is getting back to a normal market. This is where this would normally trade with these pension funds and things like that. What that reporter is asking, are you going to sell mortgage-backed securities, which would be a bad thing. That would really, really interrupt interest rates and really send them to the moon. because now there's going to be a flood of these mortgage-backed securities in this market that are now for sale for somebody that's going to profit or even sell them at a net zero, right?
Yeah.
And so that's what they're talking about in that. He's saying, no, we're not doing that. Like, he realizes that would be disastrous.
Exactly. And that's what the reporter was essentially asking and suggesting, that if he or the Fed were to make that decision, that it would crash the housing market. And he blatantly said no.
I'm aware of the market, and no,
And
I'm not.
we're not even
stepping in
close to that. We're not even considering that as an option at this point.